Hey, welcome back to The Dive. Today, joining us is Canadian small cap investor, Michael Gentile. But before we get into it, I'm just gonna quickly remind you to tap that subscribe button down there. Hey, Michael, welcome back to The Dive.
Hey, Cassandra, my pleasure to be here.
Okay, so Michael, we're starting to see signs of inflation. How are you forecasting inflation and interest rates?
That's a very topical question. I remember, Cassandra, last time I was on the show with you, I was talking about inflation, but it wasn't as popular. It wasn't as evident back then. I think inflation is very clearly with us. I think the Fed is talking about transitory inflation, which I do not at all believe. If any of your viewers have gone shopping, built a new home, grocery basket, pulled up their car, everything is up substantially more than the Fed is forecasting or telling you with CPI prices. So I predict inflation is going to stay hot. I also think the Fed wants inflation. Last time we spoke about debt and interest rates and how the government cannot afford to pay back the interest on their debt. So I think the Fed wants inflation to be very, very high going forward and wants to keep a lid on interest rates as a way for them to afford to pay back their debt with cheaper inflated dollars in the future. So I think inflation is going to be here with us. I think it's going to be stronger than people think. I think it has some severe repercussions or consequences for the rest of the market, certain corners of the market as well.
Given the macro environment, do you think we are looking at a long-term bull market for venture and small cap stocks?
I think it depends where you're investing. So with my views on inflation remaining hot or being hotter than people think, I think hard assets are going to do quite well, at least on a relative basis. But in general, with inflation picking up, it's typically a negative for valuations. So some of the high-flying corners of the market, like technology, biotechnology, corners of the market where there's no cash flow or no earnings, where companies are valued at multiple years in the future at future profits. When inflation or interest rates move higher, it's typically quite negative for those sectors. But I think hard assets, precious metals, based commodity metals will do quite well or better than other corners of the market. So I think the venture as a whole will be a bit of a mixed bag going forward in an inflationary environment. And you have to pick your stocks and sectors wisely with that outlook in mind.
Okay, let's talk gold. Do you prefer gold stocks or gold bullion when constructing your portfolio?
Yeah, that's another good question. I would say that every investor should have a 5% allocation to physical gold bullion. You don't buy gold bullion to make 10, 20 times your money like you would some small cap stocks, right? You buy gold bullion as a store of value, as a wealth preserver, as a protector against inflation or debasement of the currencies, which historically gold has had an incredible track record of preserving your wealth in inflationary government money printing cycles, which we've seen on and off for decades and hundreds of years in the markets. I'm bullish on precious metals. So I have a larger portion of my portfolio in equities because in a rising commodity price environment, you will make more money on gold producers and gold explorers on a percentage return basis than you will in gold bullion. But I think gold bullion has an anchor, kind of like insurance kind of portion of your portfolio. And if, like me, you're bullish on precious metals, then you'd want to have a lot of exposure to equities as well, who will do even better than the gold price if gold price moves higher.
Do you think the Bitcoin and crypto market affects the sentiment towards gold?
No doubt. I think if it was not for Bitcoin and the cryptocurrencies, that gold would be much higher than it is today. I think I haven't checked today what the number is, but they're well over $1 trillion or $1.5 trillion of market capitalization in the cryptocurrencies compared to around $10 trillion in the gold market. So it's taken 15% already of the gold kind of global allocation of dollars that are in cryptocurrencies already. So there's no doubt that cryptocurrencies have taken some of the upside enthusiasm away from gold. But I think the price action in the last few months has really shown, at least for now, the arguments that crypto is a store of value, a wealth preserver, a hedge against inflation have proven to be pretty inaccurate so far. Have you seen crypto since the kind of inflation fears have picked up in the market? Gold's gone from 1650 to 1850 today, and crypto's gone from 60,000 to 40,000, right? So to me, cryptocurrencies are still a very immature asset class, highly speculative asset class, being invested in because they're going up a lot. What they are in the future remains to be seen, but store of value, inflation hedge, they are not yet that anywhere close to that. But they have taken a lot of dollars that may otherwise go into gold, have gone into cryptos. You saw when crypto went down, gold started to trade higher. Some high net worth investors suddenly realized maybe crypto wasn't the great inflation hedge they thought it was and rotated some money into gold. So there is a bit of a yin and yang, a tug of war going on between gold and crypto. But my bet's on the gold and precious metals markets that have proven themselves for hundreds of years over time.
So what do you think will drive the price of gold higher at this point?
Yeah, so we mentioned earlier, inflation, I think, is going to be hotter than people think. I think it's not going to be transitory as the Fed dreams and hopes it'll be. But I think what the Fed is trying to do is the Fed run inflation hotter than interest rates. So I think you're going to see 3, 4, 5%, maybe more inflation going forward. But like I said last time on your show, the US government cannot afford rates above 1.5%, 2%. The interest on their $30 trillion of debt is just quite simply too high. So the best scenario, Cassandra, for gold is actually when you have an inflationary environment and the rates are being artificially suppressed. If you take the inflation rate minus the nominal 10-year rate, that gives you your real rate. And that's going to continue to get more and more negative over time. And if that happens, you're going to see significant appreciation in the price of gold, right? So if you take the 10-year at 1.5 minus a 4.5% inflation rate, you're going to have a minus 3% real interest rate. And that is the absolute most bullish scenario for gold. And there's about a 99% correlation between real interest rates and the gold price. So my prediction that inflation is going to run hot, interest rates are going to be capped artificially low. That is a very bullish cocktail for gold going forward. I think once the market gets past the inflation fears and it sees what that means for the price of gold, there should be a nice move higher in gold in the coming months and years.
Mm-hmm. Okay, so since the last time we spoke, you've announced positions in 2 companies, namely Captain Mining Inc. and American Pacific Mining Corp. Can you give us some color on why you were attracted to these names?
Yeah, as your viewers know, there's hundreds of thousands of junior exploration companies in the market. So what I try to do, I have a 17 plus year institutional money management background. So I really try to look for companies where I think there's a high likelihood of becoming a mine, not just an exploration story, not just a couple of exciting drill holes that get the market really excited, but projects I think have the team and the assets to become an eventual mine one day. That's really how you make 10, 20, 30 times your money in a junior exploration stock. So look at Capitan Mining. It's a Mexican-based asset, a heap leach producer. The team that's built multiple mines before in the past. The team is almost a predominantly Mexican team, have built 5 or 10 mines in the past in the same area of Mexico, very well connected, with a project that already has 500,000 ounces of gold that I see runway to 1 million plus ounces of gold, and a very high grade, silver exploration story around that as well that's yet to be tested. So it has a combination of a believable project, a believable team that knows how to build projects in country, and a very low valuation when I got involved. So I think there's a real good chance that Capitan Mining becomes a mine one day, and you're not paying a whole lot for it in the valuation today in the stock. And the second one you asked was American Pacific Mining. That one, again, another story where I think is highly likely to become a mine in the future. They're partnered with Rio Tinto, which is one of the largest mining companies in the world, as you know. It used to produce copper at 20 to 35% grade, which is just incredible off the charts grade. And when you have Rio Tinto like a partner, they're not looking for small potatoes. Rio Tinto is looking for a global kind of tier 1 potential scale. Stock was flying severely under the radar when I got involved. Rio Tinto has to spend $30 million US to earn 70% of this asset they're earning into. And the market cap when I got involved was about 10 or $12 million. So there's a real disconnect between the value of the asset and the potential and the market price of the stock. And like I said, Rio Tinto is not looking for small potatoes. So I think there's a real exciting potential there for exploration upside. You come into your market one morning and see a huge discovery. Rio Tinto is looking for some real big things over there.
With all the mergers and acquisition activity recently, do you think it will continue to stay heated for the rest of the year?
Absolutely. It actually has been quite busy in M&A over the last kind of 3 to 6 months, actually more so than I thought, because with COVID, it's very hard to do site visits. So, merger and acquisition activity, the bankers will do their spreadsheets and the negotiation will go on the border between management teams. But eventually you got to get to site and have the geologist kick the tires, see the rocks, see the mine, see what they're buying. And as you know, COVID's made it very hard to travel, right? So I think there's a lot of deals. We've seen quite a few deals, but there's many, many more deals I think that are kind of backed up in the pipeline, kind of waiting to be consummated once we are able to travel again without restriction globally. I think you're going to see a lot. That's going to be one backlog that's going to unlock. Secondly, with commodity prices moving off the lows, the larger producers are producing a lot of free cash flow right now. So they have more cash, more money to reinvest in new projects. And the larger companies have dramatically underinvested in exploration the last 10 years. So they're producing gold or copper or silver every single year, and they're not replacing what they're producing. So there's going to be a lot of pressure on them to do acquisitions, to replenish their pipeline of new assets to produce in the future. So the combination of no more COVID restrictions on travel, good cash flow, and a lack of exploration pipeline, to me is really a good cocktail for increased M&A activity in the sector going forward.
We assume you have your own shareholders network. How do you choose which investors you'd like to work with?
That's a fantastic question. And in the companies that I'm involved in, I'm a director of 4 companies, an advisor for another, and pretty significant investor in probably 10 or 15 others. And the advice I always give the companies I'm involved in is be really careful who you let onto your share register. So quite often you go to raise money in the market. Often companies that are desperate for money will take whoever shows up at the front door as investors in their company, not understanding that every investor has different motivation. So when I invest in a company, I'm looking for 5, 10, 20 times my money in my return investment. I'm not looking to make 20, 30% and sell the stock the first chance I get. There are many investors in the space, especially when you attach a warrant to your financings, where they'll take the shares, they're up 10%, they sell the shares and they hang on to the warrant as a free call option in the future. That's, called fast money, or warrant clippers, or they're affectionately called in the industry. So the companies I get involved in, I really encourage them to take the time, even if it takes an extra month or two, to canvass the market, to get really high quality, sticky anchor shareholders that have the same objectives as you as an owner of a company, which is to make 5, 10, 20, 30 times your money, that are long-term and not going to sell the first chance they get. That's really important. So the distinction between fast money and sticky long-term money is often a mistake many juniors make to their own detriment, and ends up hurting their stock prices quite dramatically when those people are back selling in the market once the private placement's off restriction.
All right, well, that's all the time we have for today, Michael. Thank you so much for joining us.
My pleasure to be here again, anytime. Thank you.
Thanks so much for tuning in. I'll be back tomorrow, so hit that notification bell so you don't miss out.